report, the 9th of October. Let's look at the events. So in today's fundamental report, I would like to talk about the US jobs data update because I think it's crucial to understand this, to have a better idea on the Fed. Now, why am I just zooming on this jobs data? Because this is the data right now that the Fed is always using to defend whatever their policies. And they, as long as people can afford whatever that is thrown to them in terms of prices, right? The Fed is still going to maintain their rates, right, at elevated levels. So what does that entail? What's going to happen next if this kind of things continue to happen? That's why I said I want to focus more about jobs data today. Now, the US average hourly earnings month to month came in at 0.2, which is equal as previous months, right? So remember this, yeah. After this, we're going to talk about it. Unemployment rate remained at 3.8. No changes to US average hourly earnings. Now, no changes to unemployment rate. The surprising data on Friday was the Non Farm Payroll data, coming in at 336,000, which is almost double the expectation, the forecast value, almost double. The forecast was 174,000, right? So to top that, right, we had an additional, now people always look at this number, but I like to look at what happened the previous month. Now, the previous month, we had a additional revision of 40,000 jobs added, bringing the non-farm payroll from a sub 200K to above 200K again. Now, what we have here is two datas right now back above 200K. Like I said before, and when it goes up 200K, that represents something that is strong, right? 200K jobs added 2 consecutive months. And this month, last month was 336K. That's a lot, okay? So this overall data represents a very strong jobs market, and it gives a total opposite view of the jobs market of the ADP Non Farm. Remember, ADP coming in at just like 84,000. So this will definitely impact the Fed's decision making, right? So looking into all this, right? What's going to happen next? Like I've already said before, the ADP here don't really represent it don't give an accurate expectation, but nonetheless, it's showing a decline. Okay, so just now I mentioned what 84, sorry, it's 89,000, right? So it represents decline, but this is like a total opposite news, right over here. Okay, so to get an idea on what's the next move, we have to monitor statements by the Fed officials this week, because we are, like I said just now, we are getting data that we are like, what's this? One showing this, one showing this. It's just neither here nor there. And also the price action is also non-conforming to what the expectation is. Okay, so like I said, look at the Fed officials, see they're leaving any clues on interest rates for the upcoming FOMC meetings. That's why I said label Monday, Tuesday, Wednesday, these 3 days, look out for it. Okay, we need to understand this part. So what happened next was, in a way, created a lot of confusion in the market. Okay, so if you were looking at the S&P 500, it first traded down upon release of job data, following it, saying that, oh, more jobs, that means they're going to increase the interest rates, right? And what happened next was that increased interest rates, that's bad for the US stock market. So S&P 500 obviously would have dropped, right? However, after dropping, that move down, it recovered the entire drop, and not only that, it managed to close higher for the trading day, right? So this bullish movement is a total opposite of what investors were expecting. So as usual, news portals scramble to explain why the move is not moving as per expectation. Among the reason given was the wage, right? It was 0.2 only increase of 0.2. So they said there's no increment in the wage, it's just maintained as before, but it's still a 0.2 increase, like it or not. I said it's a soft wage number, and that made investors rethink their earlier bearish stance. So investors are interpreting this to mean that the labor market may be able to grow without triggering another sharp increase in inflation. Okay, they see this overall, they think like that. And I said, oh, wage is okay, and not much increment, and then the non-farm numbers went up. Okay, not bad. Okay, labor market can grow, then we will have a soft landing then, because interest rates is high, jobs is still strong, people can afford it. But earlier on, if you remember, I showed that the loan delinquencies, they were increasing, right? So of course we will then monitor this next month, the last previous month data, to look at the delinquency. If delinquency rates try to plateau or drop, then maybe they are right, but we have to see. So far, whatever we've seen previously, we don't see that. Right? So the other reason they gave was the because the bond yields pull back from a high, it pulled back, so S&P became bullish. And from the technical perspective, they say S&P gotten extremely oversold already, so it should move up. This kind of reasons, whatnot. At the end of the day, there's always reasons why the market move in a certain way. So in the short term, the market may can be irrational, but in the longer term, logic will prevail, right? So if you look at this chart right over here, what you're seeing is that the 10-year bond yields made a high of 4.887 pre-Non Farm Payroll news release. And then after its release, it dropped down, and then it started moving up again, right? So this is something that the traders are actually looking at to understand, what's really happening and what could happen going forward right over here, to the data. So upon release, we saw bond yields drop 0.126%, right? 0.126%. And take note that this low here, this swing low here, is not being taken out yet. So yields could still make a new high. Okay, yields could still make a new high from over here, because from technical perspective, we has made a new high to establish that uptrend. So it came down, yes, but it's still going up. So we have to check tonight and we'll see. Yeah. So as explained in the previous reports, as long as interest rates remain high, and as long as data does not suggest the Fed will be looking into cutting rates, the S&P bullish position is always being threatened, whether you like it or not. So how much longer can the labor market remain resilient in the face of high interest rates? That is a question that we need to see. But if you think about it, if the interest rates keep on going high and maintain there, this won't be for long, because it's going to affect the profits and expenses and everything, right? So if you add that with the current oil prices moving up some more, with the on-scale threat of the war, what do you expect more from the markets? Is going to be worse. As though that one war is not enough, the Ukrainian war, Ukraine-Russia war is not enough. Now you have the Gaza and the Israeli war to add in to burden the whole market again. Of course, things can only turn for the worse if things remain as it is right now. So in the end, the price of S&P may rise in whatever reasons the market sees fit. But end of the day, it is still expected to drop, okay, based on the fundamentals that we are seeing right now. Yeah. Okay, so that's the end of the fundamental report for today.